Good afternoon, everyone, and thanks very much for joining us. I'm John Orchard, ONFIF CEO, and welcome to our discussion on global public investors, which accompanies the launch of our 2020 survey into their asset allocations and intentions. A few housekeeping points, if you'll allow me. This session is on the record and will indeed be recorded, as you've just heard. If you have a question at any point throughout the meeting, please type this into the questions tab. This is on the box on the right-hand side of your screen. And if you can't see it, please do also email ONFIF directly with your questions. When you do have a question, please let us have your name and institution, and the main bulk of questions will be answered during the panel discussion later. We really do welcome them and we'll work hard to integrate them into the discussion if we can. Now back to the substance. Although the practical circumstances have been tough, for obvious reasons, we've been lucky with our timing on GPI. ONFIF's survey was in the market as COVID hit, so we have an insight into where GPIs may go next as they digest the economic and market information from the crisis, including the huge amounts of QE and the fiscal stimuli that we've had, set against, in some cases, horrendous economic indicators. And perhaps unsurprisingly, we found a mixed and intriguing picture of the hunt for yield carrying on in plenty of places, while others moved to a more risk-off approach, and I'm sure we'll discuss that later in the panel discussion. We've surveyed and analysed about half of the $40 trillion in AUM at GPIs, which is slightly more than we got last year at a time when overall AUM have grown. I think it's a very solid representation of what's likely to be going on. My colleague Danai Kyriakopoulou, our chief economist, will take you through the key findings in a little while. David Marsh, many of you know him, who's chairman and founder of ONFIF, will chair a discussion on the results. And we have some great presentations from well-placed industry commentators. In a moment, we'll hear from Ludger Schuknecht, Deputy Secretary General for Fiscal Policy and International and Financial Monetary Policy of the OECD. But before that, I'd like very much to thank our sponsors for supporting this event and the publication. Amundi, Aviva, Bearings, BNY Mellon, Capital Group and DZ Bank, as well as our array of esteemed contributors. Now, without further ado, I'd like to introduce my friend Frank Scheidig, Global Head of Senior Executive Banking, who will be in conversation with Ludger Schuknecht. And Frank, you were presiding over breaking news for us this morning on the euro, so please carry on. Good to see you.
Thank you, John. Yes, good afternoon to everyone, and it's my honor to be here as every year at the GPI Lounge, and it's great what David and the team, and since you are on board, John, have achieved. Congratulations, right on spot with all the themes, and beside the fact that obviously sustainability, ESG, finance and investments, which is our topic in a minute, I think COVID-19 and social bonds and all what comes along for the recovery plan throughout the world, but in particular of Europe, I will refer to a little bit in the conversation I have with Ludger. Ludger is an old friend, and I get to know Ludger since 7 years ago, when we both fought for Europe and Germany to become one of the first hubs for renminbi offshore financing and trading, which is still not the easiest way to pursue, knowing that the legal system outside the EU restrictions in China and its hubs are not so easy to work with. Yes. Anyway, having said that, let's come to ESG finance. Ludger, in your previous position and also in your current position, you always were very close linked to fiscal policy and obviously have overseen the economical ongoing on the sovereign basis. How much do you appreciate the approach of the Green Deal? And don't you see also the risk of greenwashing coming along the line? Or would you exclude that for Europe and the EU, as well as for the UK and others? So what is your objective and what is your thinking about that?
Yeah, thank you, Frank. I'm very pleased to be part of this conversation. I think that the European Green Deal will be a very important development, and the national policies around it that we are seeing and is as well. Still, there are some very important challenges to deal with if we want to see ESG finance to become even more successful and firmly established and also fully credible for the long run. You know, I would say we are still in the phase where we have teething issues, and here I'd like to make reference to a recent OECD study that looked at major providers of ESG ratings, and they found that a high rating on an E pillar of ESG does not translate into lower carbon emissions. So no correlation between companies' environmental performance as measured by the rating and carbon emissions. I mean, this is something I refer to as an example of the important challenges we have this area. And the study also contrasted carbon emission levels in a standard index of fund against an ESG focused one. And it found that for some index providers, the weighting of companies in the most polluting industries was also roughly the same. So no discrimination between polluting and non-polluting industries. And it looked at hypothetical portfolios from the three major providers where they tilted portfolios towards the environmental pillars scores with an ESG rating. And this tilting of portfolios showed increased CO2 emissions against a regular portfolio for two of the three providers. So this shows some of the challenges we are still having in this area. And of course, if this, so to speak, then became the impression about the ESG finance, it would constitute a credibility problem. So the answer in this area is, of course, that we need to look at a wide range of quantitative metrics. Or we are actually, there is a wide range of quantitative metrics and scores that are calculated and weightings, which allows so much discretion and not enough transparency for this kind of study results not to appear.
Okay, Ludger, we talked about the sovereigns, but don't you think the make or break will come from the real economy? I mean, we are going towards to 2050, where we want to be carbon neutral in terms of emission and output. Don't you think the next 30 years, let me call it transition period, which is a quite common description for that next 3 decades? Don't you see here are the chances? And my question, a little bit more detail to you, the EU has just defined, or it's finishing to define, its EU taxonomy. But this is mainly about green, and SDG, ESG is so much more social, particularly in the current environment with COVID-19 and so on and so forth. So how do you see that relation into the translation into the real economy? Don't you think this is a multi-trillion euro chance as well for the backbone of Europe's economy, the Mittelstand?
I think that you're fully right there, and if you let me start with that issue of taxonomy. I mean, this is also, it's our view also that improving the transparency is key, and we need to enhance the consistencies of scores via a good alignment of ESG ratings, and a sustainable finance industry should have a sustainable finance reporting metrics that is highly relevant to investors and stakeholders, not only from the perspective that I described before, that you actually, if you want to buy green, it should be green, but also from the perspective of risk returns. Where if you in principle, if you are having a narrower investment focus, you'd have more volatility, but we need transparency on both sides, on, so to speak, in how far ESG is ESG and what is the risk return metrics implications. And I think the taxonomy work of the Commission is a very good element in moving in this direction. And therefore, I'm highly appreciative. And linking that to what you are saying about the decarbonization and the 30-year perspective that we are having, and I mean, let's be honest, you know, it's not over in 30 years. I mean, technology will move on, and you know, even if we in Europe manage, perhaps other parts of the world will not fully manage. But I think this decarbonization will indeed give rise to a multi-billion-dollar investment opportunity, which should not just be open for big, but also for small and medium-sized enterprises, and where they should be part of. And therefore, I think you're fully right. I mean, this industry is going to be, this ESG side is going to be extremely important. Now, I've commented mainly on the E side. Personally, I find the S and G side a bit more difficult to understand and to follow, and I don't really want to judge too much on that. Generally, I find it is important not to pack too many objectives into, so to speak, one score and one indicator. And here, you know, part of the results of the OECD study that I mentioned are driven exactly by the fact if you have a high S and G score and a low E score, that may dominate the E. But you know, investors may find that complicated.
Okay. Luca, I want to draw the attention more to what is currently agreed on, and now the technology will come into the markets. The EU will become, for the first time, for its own gigantic issuer. I would call them multi-sovereign issuer. It's quite a new dimension. So far in the past, if they were in capital markets, they have risen money for, let me call it more for projects, like in Palestine or for other things. Now, for the very first time, they come in first with their SURE program, which is 100 billion of size, which is going to roadshow in the end of the third and the fourth quarter this year, and comes into the market with the first issues. But the huge and the big one is going to come in 2021. These finance of the 750 billion recovery plan and Green Deal. Having said that, there were a lot of caution as well, or cautiousness and critic about, oh, another way towards the Eurobonds. What is so difficult on this discussion? Because given also your experience you had before from the Ministry of Finance in Germany, is it so bad to have one DMO for the European members funding themselves on different levels on a whole, instead of having this patchwork of so many different sovereigns? And I will clarify the question a little bit more specific. I think, to my 32 years of experience in capital markets, for the very first time, we will give the world as the EU, if we want and do it right, alternative currency, the euro, instead of just the dollar, particularly for the GPI investors who are in this call and who have done a lot of contribution to the survey. And second, with it comes a first-time serious alternative to the US Treasury market, which must be particularly welcome in the great big investors, state investors, SSA investors in Asia. It's also a political dimension, and with it comes as well, most likely a chance that the Europe will show Asia a reference rate for the derivative trading and pricing, which is just 1 day old instead of a 2 days old reference rate, swap rate for the US. This all together could be a big game changer on capital markets and super sovereign agency funding. What is your opinion on that? And do you see a great chance here for Europe and the rest of the world to become more in balance?
Yeah, thank you, Frank. This is, of course, one of the key issues right now. And I mean, there is multiple angles to this question, or this statement and question of yours that links up with the role of long-term capital and the interest of investors. I hope I get all the points short and clear. Now, this is indeed a big change in Europe. And there is some skepticism, but I think there is also an open reception. And you mentioned the key word, when it will achieve all the positives you've mentioned, and that is if it's well done. I think if it's well done, if it's implemented well, that's the key. And that's also the way then to calm the critics. So what is, so to speak, to my mind, not essential here is the institutional centralization. One debt management office, just one debt issuer, that just one instrument. I think that is not the key. We have basically now got the EU with a new role in the market, and in a way, it is what it reflects Europe, that we are a number of players that are in a way also in a bit of a beauty contest, and I think that beauty contest is a good thing. So let me then say what is needed for this to succeed. I think what the members and the heads of state agreed in Brussels, that is key. That in a way, this package is complemented by the necessary country action. And I don't just mean Italy, I mean all countries. All countries are going to benefit, and all countries need to do their homework. It, of course, is more urgent for some than for others, and I think this will be key for the critics to be dispelled. That really the money is well spent. Now, can we really expect that 700 billion is spent on infrastructure investment as additional money in just 2 years? Perhaps not. But I think even that is not the key. I think the key is that this package, together with the measures that countries promise, increase the credibility of the countries, the credibility in terms of their growth prospects, and the credibility of their fiscal prospects, because that will then strengthen the perception, will raise the perception of the euro area as a strong economic zone, where then the EU debt instrument is going to be a good, credible instrument, where also for repayment behind it, there are strong players. The strength of the players is important for the repayment of the European instrument, but it's of course important also for the strength of the country instruments, of the country debt. So I think we have here the great potential of a big win-win, and a big kind of growth also in terms of investment, infrastructure related investment. But we have to really grasp that opportunity. And I leave it at that back to you,
All
Frank.
right, I think we are also done in time. Before I pass on to Denai, I would encourage you all who are on that call, and as well OMFIF, to guide us a little bit over the next couple of weeks and months through and into that topic, because we can just achieve a success here and use that chance for all of us if we demanding it, because Europe has to be grown now after the euro has its currency in place for more than 20 years. It's time to show the world an alternative, but it has to be backed by action and understandable translation from the members of the 27 remaining EU governments. And I do hope that we don't fund ourselves in other currencies, that we definitely use the euro and give the world a second chance of a new market and alternative to the US dollar and the US treasuries. With that, thank you very much, Ludger. And thank you again to OMFIF. I wish you a good continuing afternoon on the GPO lounge, and as well to all the speakers. Denai is taking over now. Denai, you have the word. Thank you very much.
Thank you, Frank. Thank you, Ludger. Thank you, Frank, for giving us some homework now that we've finished GPI over what our next project should be over the coming weeks in terms of looking into this. And very insightful discussion as well, and I think works well as a bridge to the GPI themes that we're covering, both the ESG angle that you've spoken about, the euro issuance and the sovereign issuance, all things that we're covering in the GPI. But for those new to what global public investors are, so on to the next slide, which introduces the global public investors. This is a group of institutions that we at OMFIF are defining as institutions that manage public money. I think if someone can put themselves on mute if you're not speaking, there seems to be some background noise. Thank you. So global public investors are institutions that manage public money. The OMFIF study this year looks at 750 such institutions spread around the world. So we have under 500 pension funds, 87 sovereign funds, and 174 central banks around the world. Most of these institutions, 247 GPIs, are in Europe, but in terms of the collection of assets, Europe has actually a lower share than both Asia Pacific and North America. I think someone should put themselves on mute again. If you're not speaking, please. Thank you. In terms of GPIs, Europe has quite a lot of pension funds. A lot of these are located in the UK, but also 12 sovereign funds, which compared to other regions, the Middle East, Asia Pacific, North America, seems to be punching below its weight. So there's still scope for more sovereign funds to be set up in Europe, and we cover this in the report as well. In terms of assets, the highest concentration is in Asia Pacific, which with over 38% of the total assets. And I can appreciate this slide may be hard to read. So just as a technical point, you can all zoom into the slide. I believe the most computers have that functionality where you can zoom in and out to look more closely, but they're also available on the report itself. So this is a snapshot of what GPIs are, where they are, most assets in Asia Pacific, most GPIs in Europe and North America. We can move on to the next slide. And this shows the evolution of GPI assets over time. So OMFIF has been tracking these assets for 7 years now. This is the 7th edition of the Global Public Investor. And for the 3rd year in a row, we have GPI assets increasing. There was a slight dip at the end of 2016, and this year they increased by 1.9 trillion. So this is quite a significant jump. It's around 5% year on year. When you consider that global GDP growth was under 3%, the assets of these institutions grew quite heavily. And that means that in total now GPIs hold 39.5 trillion of assets. So this is equivalent to over 43% of the world economy. So they're quite a big part of financial markets. What's important to note here is that these data around the assets under management that GPIs have go up to the end of 2019. So they won't have captured any draws on reserves that may have happened during the COVID pandemic. But what this shows is that a lot of these institutions entered the COVID crisis in quite a good place with quite a high level of assets. And you can see here that the pension funds were the ones that grew most strongly. They're also the most institutions out of the 750, but they grew their assets by around $1 trillion compared to central banks and sovereign funds that was a few billion. If we move on to the next slide also to see the regional picture, Europe was the region that grew the strongest, so 8.5% growth year on year. That was mostly driven by central banks and sovereign funds, both of which grew by around 10%, and pension funds grew by around 6%, 6.5%. So Europe is really leading this growth. North America and Asia Pacific also grew quite strongly. In China, while we saw the central bank increase its reserves, the sovereign funds and other funds saw their reserves fall, which is something that we're also seeing for the first time, some challenges in China. And in terms of other regions, Middle East, Africa also grew somewhat, and in Latin America is the only region that we saw GPI assets decline. This was both the case for sovereign funds at a double-digit pace, but also for the central banks at a slower pace, but still a decline. And if we move on to the next slide, the growth in the AUM, so the 1.9 trillion that I mentioned, a third of that was driven by just 5 funds. So the Japan's government pension investment fund, this is a fund that has invested quite heavily in equities recently, has changed its frameworks that it's allowed to invest more in foreign equities, but also in domestic equities. Norges Bank Investment Management, the Norwegian sovereign fund, the world's largest, also was responsible for this big increase. It has its most successful year on record. The Central Bank of the Russian Federation as well, so a big jump. The Dutch pension fund, ABP, it has set up a new long-term investment plan, which includes investments in infrastructure, etc. This also is in line with what Ludger and Frank were talking about earlier in terms of the real economy and sustainability, and also the military retirement fund in the US. So these 5 funds together were responsible for about 1/3 of the total increase. And then if we add the remaining top 10, that brings us up to around half the total growth was just these 10 funds. And then here you can also, if you can zoom in, see the biggest fallers and the highest climbers. So in terms of climbers, we have 2 Russian institutions, the central bank, but also the sovereign fund that doubled its assets, as well as some other institutions, ABP I mentioned. And in the case of fallers, we have 2 Latin American central banks of Brazil and Argentina, as well as Central Bank of Algeria and the Chinese sovereign fund that I mentioned before. So these are just some examples, but in the report itself, you can see the change in the AUM of all the 750 institutions. It is the only collection of these data there is out there. And there's also an interactive data bank that you can play with, which will be on our website. If we can move to the next slide, please. So what explains this increase in asset valuations? So I mentioned before that for some of the funds that have high allocations to equities, the equity market boom, the S&P 500 going up by 28% over 2019, for example, that was a major factor. Other stock markets that you can see here also had a good year, as well as the gold price. Quite a lot of central banks have large gold holdings, and that also helped their reserves go up. Another effect of the booming stock markets was also the global investment balances and imbalances. If we can move to the next slide. So you can see here the gap between world's creditors and debtors. We measure here the net international investment position, which is the gap between net foreign assets and liabilities that a country has. And in the category of debtors, you have countries like the US or France, which both ran quite a expansionary fiscal policy over 2019, which exacerbated that position. And in the case of creditors, you have countries like China, countries like Germany. And the US bull market meant that holders of US assets abroad saw some gains in their assets, and that brought global imbalances to new heights. And there is a chapter in the Global Public Investor Report, which I recommend that my colleague Chris Papadopoulos wrote, that looks in more depth in these issues around what have banks been doing in terms of their foreign holdings, how have the target 2 balances and imbalances in Europe been changing, what have been the issues around foreign direct investments. So we go into this in more depth in the publication. But going now into the asset allocation side of GPI portfolios, this is based on the most comprehensive sample that we've had so far. It covers 19.5 trillion of GPI assets. As John said, this is around half of the total GPI assets. So it's fairly comprehensive in terms of where are their assets, what kind of asset classes are they in. And you can see that overall GPIs are fairly conservative investors. Over half of their assets, around 50%, are in highly liquid, safe assets such as government bonds. They have around just over 1/5 of their assets in equities and 1/10 in corporate bonds. But the breakdown also varies considerably from institution type to institution type. So you can see a very big difference, for example, between central banks and sovereign funds. Central banks have over 66% of their assets in government bonds and just 8% in equities and 11% in corporate bonds. They have a 6% allocation to gold, whereas the sovereign funds have over 50% of their assets in equities and a much smaller share, under 1/5, in government bonds. They also have quite a high allocation to alternatives such as real estate, infrastructure, and private equity. That's 12.3%. Pension funds are somewhere in the middle, so they have just under half in government bonds, just under a third in equities, and over a tenth in corporate bonds. So that gives us a picture of where GPI assets are now. And that is part of the analysis that we did, which was done during the COVID period. So that's more current. We conducted the survey and this analysis between April and June this year. So it's a representative sample of GPIs. And if we move next, why have these institutions moved more into assets such as equities? Because yes, for central banks, 10%, 11%, 8% for equities and corporate bonds may seem small compared to what sovereign funds and pension funds have. But for institutions like them that are fairly conservative investors, and we'll hear from some in the panel discussion later, this is still something that is quite an adventure to go into these asset classes. And part of the motivation for that has been the low yields on traditional assets. So we asked them the question of how has the low level of yields on traditional reserves assets affected your decision making? And you can see that around 30% of central banks said that they have increased their risk budget. That's the second option there. Which is quite a big share of central banks that said that we've had to go into riskier assets as a result. And for pension funds, the share was even higher. For sovereign funds, not so much, but that's because they had already quite a diversified portfolio. And if we move to the next slide, what are they planning to do in the future? So we asked them also in the survey, how do you expect to change your allocation to particular asset classes? And what was interesting here is that even though this was conducted during the time of the pandemic, a lot of investors had concerns about how will this affect financial markets. We haven't seen so far the economic crisis become a financial one. Policymakers such as central banks, fiscal policy have all helped prevent a contagion from the real economy to the markets. But a lot of investors, including GPIs, are a bit cautious about, will we see a market correction? We've had a bull market for too long. So some of them are planning to exit their equity investments, but still even more plan to invest more heavily in equities. Other risky assets as well, like infrastructure, real estate, are quite popular, particularly among pension funds and sovereign funds. Over 30% of them plan to increase their allocations to real estate. In the case of sovereign funds, just under 70% plan to increase their allocation to infrastructure. These are quite big numbers. But also for the first time this year, we're seeing more investors planning to add government bonds to their portfolios than reduce their holdings of government bonds. So there's also a mixed story. On the one hand, they're trying to get more return, which involves going into riskier assets. On the other hand, we see a return to safety, more government bonds, also some planning to increase their allocation to gold and cash. This is something that we've not seen as much before. Then if we go into some more specific issues that we covered in the GPI this year. So one was about currencies, and we heard from Frank earlier about the rising importance of the euro. It's not there yet as a challenger to the dollar, and we have Christopher Smart later speaking on the panel, who's also an expert on this and has spoken a lot about this. But we see here a lot of investors planning to increase their allocation to the euro. Also, some of them planning to reduce it, same with the dollar, more increasing than reducing. We also see some appetite for renminbi allocation to the portfolios, but this is still very modest. And a lot of investors that we spoke to said that they don't see the capital markets openness at a level that encourages them to increase their allocation substantially yet. Another area around currencies that we covered this year is also whether the challenger to the dollar may not come from another currency like the euro or the renminbi, but from a digital currency or a synthetic hegemonic currency. If we move to the next slide, we asked them specifically about how would you see, what would you be open to allocating part of your reserves to a synthetic hegemonic currency for digital SDR, so to speak. If we can move to the next slide, please, which is something that public investors are still very conservative about. This was something that former governor of the Bank of England, Mark Carney, spoke about in one of his speeches while he was still governor. And it's something that we wanted to start investigating. It's still not a mainstream idea for the GPIs, and you can see only 13% of pension funds and only 11% of central banks said that they would be even open to considering this. But we have a special chapter in this year's GPI that my colleagues Pierre Ortleb and Bhavin Patel wrote about, And we also look forward to exploring this issue more through our Digital Monetary Institute that we set up a few months ago, and where a few of you are members as well. So the issues around digital currencies, how the new monetary system will be evolving, is something that we plan to cover more in GPIs in years to come. Then if we move to the next slide, please. One of the big themes that we sought to cover in this year's GPI was this balance between safety and risk. And one of the aspects through which this manifests itself is through investments in technology. So quite a lot of sovereign funds are investing directly in technology companies, pension funds as well. And we have a chapter in the GPI looking at sovereign funds investments in technology that some of my colleagues worked on, which I highly recommend. We asked them what are the motivations for investing in technology investments, and the number one was higher returns. Tech equities have had quite a good rally. Also, other factors that were not mentioned here are, for example, the high ESG scores that some of these technology companies have, because they're not in manufacturing, high polluting sectors. There is a high correlation. We heard earlier from Ludger the issues around measurement and ratings there, which is something that definitely needs more attention. And UNFIV will be publishing a report about this together with data provider Refinitiv in September, looking at sustainability data. We're also setting up a Sustainable Policy Institute that will be looking more into this. But for now, it's something where metrics are still not quite clear. If we move to the next slide, the second way in which we looked at how public investors plan to manage the balances between safety and risk is also how they approach foreign markets. So we looked at what centers, financial centers globally, are home to GPI representative offices. So we all know at UNFIV how in our London roundtables, we always have the representatives from many central banks around the world that join us there. New York is also a big a GPI hub, and quite a few Asian cities like Beijing, Singapore, Hong Kong, and Shanghai and Tokyo as well have many GPI hubs. And then San Francisco as well, this plays into the GPIs wanting to access some of these technology investments. And it's also interesting to see which GPIs have the most international presence. And it's actually the Bundesbank that has the greatest international presence in 12 cities globally. And we have a representative, Martin Wieland, speaking at the panel later on. So well done on that number one that the Bundesbank gets there. If we move on to the next slide, another big theme that we had in this year's GPI was how they are rediscovering their public ethos. So with moving out of the shadows, central banks especially used to be more concerned with looking after the plumbing of the financial system through their unconventional policies. They've been more at the forefront, and with that comes increased scrutiny, calls for transparency, calls for more public engagement. And one area where this is very obvious is the area of sustainability. And together with Bank of New York Mellon, we published a chapter in this and a report based on a survey that we did of sovereign funds and pension funds in terms of how they're looking to integrate ESG. This is an area where central banks have done a lot of effort in terms of their supervisory practices. So we've seen climate stress tests, microprudential policies, etc. But on the reserves management, they're more conservative. And Ludger and Frank already covered this quite well. But one slide that we have here is looking at what are the top risks in terms of the material risks that they face in their 10-year investment horizon. And systemic environmental risks were number one. We'll hear later from Francis Barney from BNY more on this topic. The second area about rediscovering their public ethos is also about their communication. So last year, we looked at central banks communicating through Twitter. We looked at which were the central banks with the most followers. It was Bank Indonesia and Banco de Mexico. This year, we looked at how they're engaging with the public through their art collections. So we have a chapter in the publication looking at when were art collections set up, how do they invest in art? And I know the Banca d'Italia also has a very interesting collection, which we featured in the report. And we have the deputy governor speaking later in the panel. But looking at which were the oldest collections, how do they use them to communicate with the public through museums, through apps, through joint exhibitions that the Bundesbank, for example, has done with the National Bank of Belgium. So that's another chapter in the GPI. And then finally, Another area where GPIs are rediscovering their public ethos, especially at this time of the pandemic, is how they are supporting government pandemic responses. And we have all seen how central banks have done that. The ECB, for example, launched a pandemic emergency response program. The Fed has new liquidity facilities, and the Bank of England lowering interest rates, etc. Sovereign funds have been operating more behind the scenes, have not been covered as much, at least in the media. We wrote a chapter about this, how some governments are drawing directly from their sovereign funds to either support the value of the currency or to directly get funds into the state coffers to be able to then be able to support the fiscal policies that these governments are doing to support the pandemic, from the pandemic. So Azerbaijan, Chile, Nigeria, and Norway are all examples of that. Other sovereign funds are supporting directly struggling industries such as airlines. So Singapore, Malaysia, United Arab Emirates have all done that. Others are issuing bonds, pandemic response bonds, for example, Italy CDP or BPI France. And others are also helping through donations or investments in the healthcare sector. So that was, for example, the Russian sovereign fund that helps co-fund a COVID vaccine. So these are some areas where sovereign funds are helping. If we move to the next slide, these are just some of the chapters that there are 10 chapters, as well as the survey analysis in this year's GPI. They include analysis from my colleagues in the research team, as well as contributions from GPIs themselves, such as from the deputy governors from the central banks of Spain, of Ireland, representatives from sovereign funds from Italy and France. So I highly recommend looking at individual chapters based on your interests. And thank you very much for your attention. I'd now very much like to hand the floor to Anshula Kant, who is Managing Director and Chief Financial Officer of the World Bank Group, a post in which she has been since October 2019, and where she looks after financial reporting, risk management in the World Bank, and before that she was also CFO at the State Bank of India. Welcome, Anshula, and the floor is yours. Thank you very much for joining us today.
Thank you, Danny. Thank you very much for the interesting walkthrough of the GPI report. I'm actually delighted to join you today at the launch of the 7th GPI report produced by OMFIF. I particularly found interesting the chapter which you mentioned on public outreach by central banks by way of Twitter and their arts program. I look forward to going through that. So today, I would like to talk about some of the challenges that central banks and public investors face and are likely to face in the aftermath of the pandemic, and the essential role they play in sustainable recovery. I will also touch upon the World Bank, how the World Bank is making a difference towards a sustainable recovery, and the ways we can partner to champion and promote sustainable capital markets. But first, a few words on the new economic context. I think, as we've all been discussing across the world, COVID-19 impact has been very, very damaging. It has led to the deepest global recession since World War II. In a best case scenario, we expect that the global economy could shrink by 5.2% in 2020. Globally, we will see the first increase in poverty since 1998. And as it disrupts billions of lives and livelihoods, the pandemic threatens decades of hard-won developmental gains. Recovery too is likely to be slow, and growth forecasts for global economy are around 4% for next year. So central banks, in this time have been playing an essential role in responding swiftly to challenges of the pandemic. As you mentioned in your presentation itself, with the purpose of stimulating the economy and preserving normal functioning of financial markets, central banks have gone beyond their traditional role of lenders of last resort. Policy rates have been cut by approximately 80 basis points in developed economies and almost 100 basis points in emerging market economies. Balance sheets have expanded at an unprecedented speed. For example, G4 central bank balance sheets have expanded by 20% of GDP over the first 3 months of the pandemic. Some asset purchase programs have been adjusted to include the purchase of corporate bonds, and this is particularly important given the effects of the sudden stop in economic activity on labor and corporate income. With national governments working fast to strengthen healthcare systems and protect the most vulnerable, central banks have played a critical role in supporting the fiscal policy response. Under different institutional arrangements, central banks have developed lending facilities to implement the credit backstops provided by governments. Notably, I'd like to mention that Federal Reserve offered USD FX swap facilities to several central banks and inaugurated a repo facility designed to provide collateralized lending of dollars to foreign central banks. These measures were timely and effective, reducing dollar funding pressures and preventing large-scale currency depreciation in many emerging markets. While all these nimble actions have helped stabilize financial markets, their medium and long-term impact remains to be seen. Central banks will have to rethink their policy toolbox to navigate further these uncharted waters. While monetary policy should continue supporting economic recovery as long as is required, once the world economy is back on track, policy will need to be normalized. This phase will be the most challenging, I believe, and will require a careful unwinding of the extraordinary policy measures to avoid disrupting financial markets and allow for efficient risk pricing. In the meantime, financial systems will have to cope with recessions and impact on credit quality. While managing their country's foreign exchange reserves, central banks are public investors, often rather conservative ones, as you mentioned, Daniel, keeping a close eye on capital preservation, liquidity, and safety of their portfolios. The GPI report, as well as our own survey on central bank reserves management activities, this is conducted by a program called Reserves Advisory and Management Partnership, which is run by the World Bank Treasury. Both these reports actually and survey make us think of another role central banks can play in economic recovery. In addition to the traditional risks, many of which have been exacerbated by the pandemic, public investors need to keep in mind another risk affecting the world, and that is climate change. This risk has significant implications for long-term risk-return profile of assets. Here, investors can make a difference by financing projects that help advance a low-carbon economy. They can also contribute by incorporating environmental, social, and governance principles into their investment policies. In fact, GPIs are starting to recognize that climate change risk has the potential to destroy significant global economic wealth in the coming decades, and regulators too have warned of the potential investment risk from assets that become unsellable because of climate change. The first step for institutions seeking to adopt sustainable and responsible investment principles is to get a clear mandate on this from their stakeholders. Once the investment objectives are updated to include ESG principles, implementation becomes the next challenge, especially for central banks, as many of them operate in the high-quality fixed income space. In this space, the availability of instruments where ESG considerations play a straightforward role in the risk-return analysis may actually be discouraging. But I'm happy to say that this is an area where the World Bank makes a difference because of the bonds we issue. In FY20 and our financial year closes in June, we stepped up our bond program significantly and we issued around $80 billion. We expect to do the same this year. Central banks, official institutions, pension funds are already significant investors in our bond program. At the World Bank, we understand that financial markets play a vital role for the real economy as they provide financial solutions to tackle the world's most pressing problems. We work with countries to design programs that meet their development priorities and advance our mission to end extreme poverty and build shared prosperity. We look for ways to achieve positive environmental and social impacts as we design our projects. Because we work closely with our client countries to design programs, when times call for it, we can be nimble and we can adjust quickly to reprioritize projects to help governments address new and urgent needs. This has proved critical as our clients combat COVID-19. But besides addressing the immediate health threat from COVID and social and economic repercussions, we have been maintaining a line of sight to a client country's long-term development vision, not just to get development back on track, but to identify opportunities to build back better in a greener, more resilient and sustainable manner. Based on country demand, we will continue to embed aspects of green climate-friendly recovery into stimulus packages. In the context of sustainable recovery, I would like to point out the steady shift we have seen in investor behavior over the past years, with investors seeking to do good while doing well. The World Bank has helped drive this shift as both a leader and a key partner in efforts to build sustainable capital markets. We played a founding role in the development of the green bond, social bond, and sustainably linked bond principles. We have partnered with asset owners like Government Pension Investment Fund of Japan and Network for Greening and Financial System, and we have convened investors and sovereigns to engage on ESG concerns and opportunities. For investors in our sustainable development bonds, it provides an opportunity to align their investments to SDGs and to implement ESG strategies. We communicate extensively with investors to help them understand what the entire World Bank balance sheet finances, not just our green bond portfolio. And very briefly, I'd like to add that addressing climate change through our financing has been a very important goal for us over the years. In the last fiscal year alone, 31% of World Bank financing contributed climate co-benefits. Going forward, the World Bank Group will invest and mobilize up to $200 billion in climate-related financing from 2021 to 2025, doubling what we did in the last 5 years. The green, social, and sustainability bond market is essentially about purpose and transparency. We must continue working towards broader transparency and increasing information and data so that investors have better information for decision making for their investments. To conclude, I see genuine cause for optimism given the financial markets have been doing so much to embrace ESG considerations and bond issues that are specifically designed to support sustainability objectives. This puts us in a stronger position to support the kind of sustainable recovery that countries will need as we emerge from the pandemic. It makes me hopeful that we can get developing countries back on their feet, help them advance on their development goals, build more resilience, and improve people's lives. Thank you very much for the invitation to speak, and it was a pleasure to join you today. Thank you. I'll stop here.
Yes, thank you very much indeed, Anshula. This is David Marsh. I'm the chairman of ONFIF. I'm calling you now from Berlin, where I've been for a few days, and I'm wearing a tie as well for the first time for about 3 months. That's in your honor, Anshula. Thank you very much indeed also for telling us also about what the problems are in terms of poverty and, as you said, rolling back some of the very good work that you've done over the years. The world has got very, very big challenges. Thank you also for really accentuating this issue about climate change and the massive amount of financing you're going to be doing in that area. We're very, very grateful to you, Anshula, to take the time, and we look forward to working together with you and all your colleagues on these issues in coming years. I'd now like to go on to the panel, which will be discussing this slew of statistics and analysis. I'm sure you're all feeling fairly taken aback, as I am, by the amount of coverage, but we've got another hour to go to digest all this. We have a panel of experts made up of the private and the public sector. I'm going to introduce the panel very quickly. First of all, with Christopher Smart, who's in charge of strategy and macroeconomics at Barings, the big US asset manager. We have also Luigi Federico Signorini, Deputy Governor of the Banca d'Italia, a very large holder of gold, I might add. Martin Wieland, Head of Market Intelligence at the Bundesbank. Martin, indeed, was in London, one of the 12 places around the world where the Bundesbank does have representation, as was mentioned before. And then we also have Sevinch Ajar, who is Investment Director at PGGM, the big Netherlands cooperative pension fund manager with, I believe, about 240 billion under management, euros, that is. And then we go on also to Didier Borowski, Head of Global Views at Amundi, who'll be giving some immediate responses. First of all, Christopher, you're a man of many parts. You played a role in government before you joined Barings. You heard just now a story about the euro and how Europe may at last perhaps be fulfilling its potential. That's something you know a great deal about, having been a government civil servant. But can you tell us first of all about how you see the world economy, particularly the dispute between the United States and China, and of course a look into the crystal ball, what might be happening in November? Over to you, Christopher. Thanks very much for your support. Thank you for being with us. You're on mute at the moment.
As good as I try to get at these video conferences, I always forget the mute button. But in any case, thank you for the invitation to be with you. Very interesting program so far, especially interesting to hear from Frank and Ludger earlier on in the conversation. And Denai's once extraordinary tour de force reviewing the GPI is a credit to her and to all of your team. I think in terms of the global recovery, we're all sort of bracing still from the effects of the great pandemic and the great lockdown. And I think what we have before us right now is the great puzzle, which is that if you had told anyone, I think in March, that the S&P 500 would deliver the best returns since 1988, you would have gotten a lot of tilted heads and sort of bewildered looks. But I think what we've had is not only this tremendous blow to the economy, but unexpectedly a very extraordinary, not necessarily coordinated, but simultaneous response from both fiscal authorities and monetary authorities. And that is the great story of this year. And I think as we look ahead, if you will, into my crystal ball for what it's worth, the competing forces around the recovery, how long will it last, how deeply is it entrenched on the one hand, and government support, how long will it last, how deeply is it entrenched. I think one of the lessons we learned in the United States, and I think in the global economy generally after the Lehman crisis, was that we generally took away stimulus too soon, took away fiscal support too soon. Certainly we didn't have enough in the United States and not nearly enough in Europe. And I think it'd be an interesting panel at some point to invite finance ministers who have lived through financial crises and ask any one of them if they thought they had been given too much money during the crisis. I think almost any one of them will say, more money is always good going through.
Thank you for the idea for next year, Christopher.
Well, I think that's what we're going to be looking at next year. But I think what markets are looking at is some sort of in a sense, it's a pandemic put. The worse the news is on the pandemic, the more comfortable markets are that the governments will continue to respond. And you have those signals from central banks, and you certainly have that in the offing. You may have read that we have an election coming up in the United States, and we have some negotiations going on this week in Washington. The voices arguing that we need to balance our budget sooner rather than later are very few and far between. So I think that's just
on something which is happening in the next few days, Christopher. Can you tell us about whether there will indeed be another recovery package put through Congress, where there seems to be a bit of a standoff?
It's very hard to imagine that Congress will disperse without delivering some sort of a package, and it probably has to be above $1 trillion. Now, I say this having lived through the TARP negotiations where Congress voted it down a couple of times before they voted it through. So it's hard to know how that dynamic will play out. But at least right now, it seems that even though the Democrats do not control the Senate, they, in some sense, have the upper hand. Republicans don't want to go home without delivering something. They're very divided as to what that is. And so more likely than not, the Democrats will leave more of their fingerprints on the final package right now than the Republicans.
Just a very final question to you before going on to Luigi Federico on China. Will there be saber rattling with China, and will that help the incumbent in the White House?
Well, there will be, there has been saber rattling, there is saber rattling, there will be saber rattling. Whether it will help the incumbent, it's hard to know. I mean, there are a lot of moving parts in this. He clearly believes it will help him, but I think there won't be a lot less saber rattling under a Biden administration. I think it'll be different. The tactics, the tone may be different, but the entrenchment of the U.S.-China relationship, I think, on both sides is with us for quite some time. I'll just offer one last thought. The interesting thing in all of this is the dog that didn't bark, in some sense. As we have been dismantling bits and pieces of the relationship, the phase one deal that many of us maligned and thought was nothing and didn't really amount to much, both sides continue to protect it, even though they're not really sure that China is going to make all the purchases it promised. but there is some sort of back pocket sense that, you know, whether the Trump administration continues after January or the Biden administration comes in, they want to have some place to start the conversation again.
Yeah, no, I saw your recent piece about the dog that didn't bark on China, and congratulations on Sherlock Holmes still being very popular on the other side of the Atlantic.
Never miss an opportunity to quote Arthur Conan Doyle.
And can I now go on to Luigi Federico from the Banca d'Italia? You were there right at the very beginning of this crisis. We all thought that Italy might be an exception. In fact, Italy's done rather well since then in terms of defeating the pandemic. Do you share the optimism that we heard earlier on from our two speakers from Germany about a new birth, a new dawn for Europe, and a new safe asset, or at least a portfolio of safe assets, one of which will be the European Commission bonds? Over to you, Luigi Federico.
Thank you very much, David, and thank you for inviting me. And I think I do think that the agreement that has been reached at the European level is a very good starting point, and I entirely agree with Ludger that it is important now to implement this deal. It's not the starting point is there. The need for actually using those funds efficiently in a way to put our economies back on a sustainable growth track is extremely important. Of course, we had this extraordinary impact of the COVID crisis, and as has been mentioned, this required a very aggressive monetary policy response to avert the risk of a financial meltdown and sustain economies worldwide. Like all major central banks, the ECB reacted very quickly or nimbly, to use Ursula Kant's expression. The measures taken that are well known need not be listed here. They led to further monetary accommodation, a further large injection of liquidity, and they were effective in calming markets, protecting monetary policy transmission, and preventing a financial crunch and a deflationary spiral. But this time, and I think Christopher Smart has just alluded to that, so this time other domains of public policy beside monetary policy also became immediately active. Fiscal policies responded vigorously, more or less simultaneously across the world, with measures to support households and firms. This included in varying shares, debt moratoria, loan guarantees, direct grants to firms, income support, and more. But a third side that has not been mentioned, the banking regulators and supervisors also played a key role. However, in my view, the most important regulatory actions were those taken before the pandemic in response to the global financial crisis. Thanks to Basel III and other supervisory and regulatory action, when banks were hit by the pandemics, they were considerably stronger than before the 2008 crisis. And this is true worldwide, but let me give just a few key figures for Italy. Between the start of 2007 and the start of 2020, the ratio of the highest quality capital to risk-weighted assets almost doubled to 14%. In March 2020, the mean liquidity coverage ratio stood at 174% of the mean regulatory requirement. And let me remind you that there were no liquidity requirements before the global financial crisis. And I could go on and on, but just that was just to make it a point that given the strength with which the banking system worldwide entered the crisis, banking authorities were in a position to encourage banks to use their capital and liquidity buffers. Buffers are designed to allow banks to withstand extraordinary stress due to exceptional events and avoid credit crunches. So far, thanks also to enormous liquidity injections by the central banks and ample state guarantees, there are few signs of the type of credit restriction that played such a big role in amplifying the economic consequences of the past crisis. Still, uncertainties abound. Usable buffers are important to allow banks to absorb any losses without cutting credit abruptly. And many supervisors, including the SSM, the Bank of Italy, and many others around Europe and the world, encourage a bank not to distribute dividends, not to buy back their own shares, to be extremely careful in paying bonuses. In sum, the overall short-term policy response was, I think, impressive, quite effective in mitigating the consequences of an unprecedented crisis. Of course, we shall not be able to call ourselves safe until the pandemic has effectively ended. But let's start looking ahead anyway, and I shall make 2 points in that respect. First, one of the legacies of the crisis will be inevitably an increase in government debt to GDP ratios. This is manageable and should in due course be managed. Continued fiscal support is essential at the current juncture. When uncertainty recedes, we shall need to address simultaneously macroeconomic stabilization and fiscal sustainability. Long-term sustainability of the debt to GDP ratio depends both on the numerator and on the denominator. And in this respect, let me go again to the recently agreed EU package, which is, I think, a key tool to allow member states, especially those hit hardest by the pandemic, to fund efficiently measures that increase the potential for growth, and it must be put to full use. Second point.
Sorry to interrupt, Luigi, but just before going over to Martin, could I just ask you on that point about debt sustainability, a very blank and rather simple question. Is the yield spread between the BTPs and the Bund still too high at the moment, given the economic fundamentals of Italy?
Of course, this is a difficult question in the sense that you need to make estimation of the effect of the fundamentals on the spread. The work that we are doing at the Bank of Italy shows that indeed there is a difference that is too high with respect to economic fundamentals, and I think that in this respect to bring that spread more in line with fundamentals, it is very important to rather than restore, to maintain confidence in the market. And I think that in that respect, having what I was saying before, not just responding very effectively in the short term to the crisis, but also in due course putting the country, using all available tools to put the country on a path of sustainable growth is extremely important.
Yeah, that's very important. I'm not going to ask Martin that question, but it is an important point, Luigi, and I do know you've done a lot of work at the Banca d'Italia on econometric studies on this spread. That's something we might come back to also in future months. There is a chapter in the GPI about the national investment positions of different countries, and of course your investment positions in terms of your net foreign liabilities is relatively positive. Martin, very good to have you.
Well, it's balanced. At the moment, it's basically zero. It's come up a long way since where it was in a few years ago. So it's one of the things that has changed a lot since the last financial crisis.
No, indeed. Not many people know that. For people who can't sleep, they need to turn to that table in the global public investment. Martin, and Shula Kant, she said that we need at some stage to normalize this position of this extraordinary monetary policy that we've now had for at least 5 or 6 years in Europe, not counting the latest developments. Is it far too early, Martin, to start thinking about or even talking about normalization?
Yeah, I mean, I would like to link this a bit to the kind of side effect story of a lower for longer, which in a way, taken as one single factor, would of course argue strongly, in my opinion, to at least keep this normalizing plan on the table. But of course, admittedly, when you talk about normalization in the Euro system monetary policy, the key yardstick should of course be the medium-term inflation outlook. And if you look at the latest projections we have from June, you certainly see that an inflation outlook of 0.3, 0.8, 1.3 for the years 2020, 21, 22. Of course, that argues for the time being that there's a strong case for central banks, including the Euro system, central banks and the ECB, for remaining this kind of stimulus. We can go into the details if you want. I mean, there's a clear case, in my opinion, to of course, to differentiate, and there's broad agreement, I think, the Euro system, between the parts of the individual programs. I mean, we've got an emergency program element now that we have COVID. You can, I guess, argue quite strongly that this should normally be the first part of this monetary policy stimulus that at some stage should be withdrawn, and there's in fact some communication, of course, from the Euro system there. But let me, if you allow me for 2 or 3 minutes, let me link this debate to what Danae also mentioned in terms of, let's take for a minute the investor and financial system perspective. And I've got 3 brief points that may set the current debate of potential side effects of the lower for longer a little bit apart from the story we have been having for the last 10 years. It feels a bit like Groundhog Day, of course, talking about side effects of lower for longer. But 3 brief points. The first thing that may be different now that in this respect is that we have extreme uncertainty about many parts of the outlook. Take inflation. There's a range of views in the markets about medium-term perspectives on inflation. It's not the immediate outlook. Immediate outlook, there's quite a lot of consensus that this may be disinflationary for the coming months or so. But going beyond that, a range of views. I saw GIC from Singapore out with a report. They are talking about inflation in some years' times, and seem to be worried of that. And then the second aspect here, the recovery we are going to witness now may well show a lot more differentiation. So there's an argument that I find quite convincing that topics like ESG, digitalization, they are drivers that make this recovery different from others, and that may feed back on risks and chances investors may pick up. So what do I mean by this? We are likely to have an environment where investors and lenders have, of course, chances to reap the benefits if they do things right. But for the system, there are also risks, as inevitably more investors than usually may find out that they put their foot wrong and may underestimate risk that come with this changing environment that is quite uncertain. Second point, the starting point for investors in terms of risk-free asset returns is much different than 5-10 years ago. And there's a big debate, and this may also be reflected in the GPI report in a way, I sense, that how can I diversify with these very low yields, for example, for benchmark government bonds. And there's a lot of talk about going away from classical 60-40 diversification models to increase the share of more risky fixed income, more illiquid parts of the investment spectrum. And that, of course, entails the risk that search for yield can, in a nasty market environment, may resurface in terms of
Martin, that's an absolutely wonderful lead-in to what I wanted to ask Sevinch Ashar.
Yeah, sure.
You've been speaking actually as if you were managing a pension fund, and of course the Bundesbank does manage a certain number of assets as a third-party manager for pension funds. Thank you very much for providing that lead-in to Sevinch.
Yeah, sure.
Sevinch, you are responsible for part of the investment strategy at a very large European pension fund, and you have espoused and embraced sustainability fairly early on. It's very much in the Dutch blood, we all know that. Now you're coming into your own. Could you maybe also answer the question that Martin has put? Because there clearly has been a sense of going into riskier assets. You can sometimes be throwing the baby out with the bathwater by doing that. How do you get the right balance? You can no longer just invest risk-free and get a decent return on risk-free assets. But how do you manage that when you've got to look after your roughly 4 million people who depend on you for their pensions or for their benefits? So tell us how to manage that very difficult balance.
Well, thank you very much for the invitation, first of all. In our investment strategy as a Dutch pension service provider, there is an optimal balance between risk and return is key. And for this reason, we would like to have also some safe assets in our portfolio, because we need that for liquidity purpose and also for collateral purposes as well. And next to that, because we have to provide a decent pension fund for our participants in the fund. So we are also looking for some yield, but in a very balanced way. So we also allocate money to alternative investments like infrastructure, private equity, real estate. So there's optimal mix. And next to that, we're also looking for ESG, what you mentioned before. It's in our blood, because we believe that incorporating ESG guidelines in our investment, that we can achieve better results, as well as financial results, but also social returns, which is very important for us. And the COVID-19 showed for us that the social returns are also extremely important. And maybe I would like to also raise a point as well, because there is a huge recovery and support package right now from both national level and also from European level. And this gives us also the opportunity to tie these safe assets to green and social conditions that promote sustainable activities. And I think the COVID-19 will be a game changer in order to combat climate risk and also to nurture social development as well. Basically, it's a nutshell what I.
Yes, I want to go back to Christopher in a moment, but just one point for you, Sevinch, on infrastructure. What is your experience of investing directly in infrastructure with your own people rather than investing into funds, either public or privately listed infrastructure equities?
Well, what I heard from my infrastructure colleague is that you have better control of your assets, because then you can also choose. Then you can also integrate your own flavor, your own investment target as well. So, but you need expertise for that as well, and also, yeah, that's it.
You obviously pay a bit less in terms of fees, but then you have to pay your own people a bit more. We know the Dutch like to save money from time to time, so yeah, there's a trade-off there, isn't there?
There's a trade-off, because the trade-off is that you have got better control on your assets, and that you can also integrate the ESG guidelines as also much more better. Yeah, that's the trade-off. So.
Yes, thank you. We'll come on to Didier in a moment. I just want to go back to Christopher though on the point about China. We've had quite a number of different callers now also asking us about China. You mentioned that you thought that Mr. Trump in the White House might be favorable to a spot of argument, say, with the Chinese. How do you read that? What do you think China actually wants out of the United States in the next 5 years? You're in charge of strategy, Christopher, so you should be able to tell us that.
Of course. Well, first of all, I don't pretend to be an expert on exactly what China wants. I do know enough to know that, like many other countries, to sort of say that Germany wants this or Thailand wants that is a little bit ambitious, and certainly in the case of a 1.3 billion size country, excuse me, that's even more ambitious. I think my sense is, China was working under a set of assumptions before the Trump administration, and may have miscalculated or been taken off guard by the sense of its actions on trade, but also on other issues, whether it's human rights or Hong Kong or the South China Seas. And so I think what may be a surprise to China is that this is something that is, the Trump administration has given voice to, but has really been building across both political parties in the United States. I would assume if I were Xi Jinping, I would kind of want to go back to status quo ante. But I'm also understanding that that may not be possible because, as I mentioned earlier, even under a Biden administration, there will be, unlikely that tariffs will disappear overnight. Maybe more likely that there will be more of a multilateral approach to trade where US and European policy towards China might be more coordinated than we've seen up until now. But there really will be a sense that China is such a large disruptor to the global economy that it has to grow and expand within the rules of the global economy. And so issues
and there won't be a return to what you might call the constructive engagement days of, say, Hank Paulson. That under Biden, that won't take place either.
I don't think that'll take place. I think you might get more of a coherent set of, if you do this, we'll do that, rather than the more scattershot messages I think you've got from the Trump administration. But I think there really is a sense that China does need to adjust some of its behavior as it grows and becomes a more important presence on the global stage.
Good. I'd like to go to Didier Borowski now to answer some of these points. Didier is the head of global views at Amundi. For you, Didier, you must be like a boy that's woken up and find that Christmas has come early, because you've had two of your really big themes at Amundi in the last few weeks. One is the whole sustainability question, where your company has been something of a forerunner, and then the safe assets, or shall we say the safe portfolio, with the EU now having won this agreement to issue these bonds. Those two things together, what does that mean in a nutshell for the international landscape of investment?
For the international landscape, I believe it means that for foreign investors, Europe will be seen as a more resilient region than in the past. We believe that there was some kind of political risk premium for European assets due to the fact that since the great financial crisis, and in particular since the sovereign debt crisis, foreign investors were highly skeptical about the future of the European Union, and in particular of the Eurozone. And what we are seeing these days is that we are seeing a safe haven will probably be the result of this new recovery fund. And we believe, in fact, that the world is short of safe haven, and we have a new safe haven in the making. So it's not a true safe haven. We are not living in a fiscal union. There is no outright debt mutualization, but still, it is a very significant step that should increase the resilience of the European Union, and in particular of the Eurozone. And I think it's a key element of stability in a world that is, as it was correctly said, highly uncertain on many topics. So I think it's Europe is becoming an area of stability. It's only a starting point. It will take time. The road is long. There are for sure implementation risks. But I would say that the worst is over regarding the skepticism about the future of Europe, and that should be a game changer. We do believe that investors won't continue to look at the euro in the same manner as in the past. The safe haven status of the euro will increase over time, and that perhaps what we saw recently with the appreciation of the euro, there will be a huge demand from foreign investors and even from European investors for these European bonds. And I think it should encourage European governments to continue in this direction. Something which is also very important to mention, at some point, these debts will be reimbursed. But just bear in mind also that it's a win-win game. I mean, at the end of the day, these funds will target investment projects. And we are living in Europe in an economic region which is highly integrated. So you will see some fiscal multipliers at play, plus trade multipliers that should benefit to everyone in the coming years. And that's something that should reinforce, I would say, the stability.
Thank you for those optimistic views. I've got a question coming in from the audience directly on that for Luigi, which I'll put in a moment. I would just like to remind those listening or watching this that you can put in questions. The best way of doing that is to send an email to my colleagues at OMFIF. You can also use the chat function. I've got one or two coming in already. I will have to read the questions out under the rules that we have here. Luigi, one of the listeners does ask this question. This person says, it's not actually the money. There's lots of money around. There's lots of credit. Italy can borrow relatively cheaply. It's how you use the money. That's important. And the questioner, again, a very blunt, rather brutal question. Does Italy have the project management skills to spend the money that will come your way in a way that will be environmentally, socially, and economically efficient?
I believe it does, and I think that the few months will be the opportunity for Italy to prove that. And I think that just taking up what Didier has just said, it's not just an issue of not just an issue of multipliers in the sense of short-term demand factors. I think it's even more important the fact that these funds are meant to improve the fundamental structural ability of countries to resume structural balanced growth. So this is I think the important one of the big important factors in the European agreement, coupled with the others that although we are not going to have exactly that type of safe assets that was discussed for some time with little results in the past few years. And we do have an anchor for the European bond market, which is going to play an important role, and is extremely important. Could I, David, pick up one issue that you raised, the issue of the Christmas, the Christmas gifts? I think that there is another type of Christmas gifts that we should take into consideration. We have had a very strong international action by monetary authorities, and this action has preserved stability in markets by reassuring market participants that disruption would not be permitted under the exceptional circumstances of the pandemic, which was a dramatic, full exogenous shock. In the longer run, however, it is important that investors do not start seeing central banks as, in quote, market makers of last resort, able to protect them against all sorts of disturbances, whatever their origin, but because the implication in terms of moral hazard would be vast. So I think that there is a case for building up safeguards in the future. I mean, there's a task for the future, building up safeguards against moral hazard and excessive buildup of risks in market. And we need to reflect, among other things, on a macro-prudential framework for non-bank finance. I think that there is a reflection going on in this sense at the international
that's very
level.
good you say that. I see Martin is nodding there. In fact, there's a question on moral hazard coming in from the audience, and for some reason, Martin, I thought of you when this question came in. And the question is the Fed now bailing out too many incautious investors? Because it's going to reward profligacy. Very good that Luigi, Federico, you mentioned moral hazard, but surely this is a place where the Bundesbank has to put up its finger and say,
just
no
to be
more.
clear, I'm not putting the blame on anyone. Absolutely, I think that it is an important issue for the structural financial markets in the future.
Well, you're right.
Yeah, David, I see your point. I'm a bit shy to comment for the Fed colleagues, but let me expand Luigi's point or fully subscribe to it actually, and that was my third point in the first place. We have to continue work on market functioning, or in other words, on structural weaknesses in financial markets. I mean, we all remember the scary days in mid-March when all of a sudden everything was positively correlated in markets, from gold to treasuries to bonds to corporates to equities and so on. And even before this exogenous shock hit, there were signs that we have still, after the reaction to the last financial crisis, we do have endogenous challenges in the financial system. And without going too deeply in, I mean, we have activities in the non-bank sector, like systematic investment strategies in various guises, often linked to volatility, earning premia on already low volatility regimes that can cause trouble when the direction of market sentiment changes. And that's one part. And I strongly support the initiatives that the FSB and the BIS committees, Markets Committee, CGFS may well have over the coming months after a post-mortem that is on the way. But also it is legitimate, I think, to make the context even broader and look at things we did 10 years ago, when we had very good reasons to say that banks have to be safer and so on. But of course we have to acknowledge intellectually that there are trade-offs. I mean, we don't have many market players who can catch a knife when things go badly. So it's a whole package: non-banks, banks, actors, electronic trading. What's going on there? What are the benefits?
Do you need more personnel, Martin, at not just at, say, the Bundesbank, but at the European regulatory agencies? We do have a little spot of bother at the moment in Germany with Wirecard. Mr. Scholz, the finance minister, has been called before the finance committee of the Bundestag to answer questions about this. Let's not single out Wirecard, but there is a question about the regulatory skills and whether there's the people of the sufficient proficiency to catch up with the wily types of people you get now in the non-banking area, sometimes not fully regulated. Is it a question of resorting to more personnel, training people better, and having more of them?
Yeah, I mean, I'm not wanting to link that to specific cases we have here that may have a completely different background. But my starting point is, do we understand, as central bankers and regulators, do we sufficiently understand the details of the mechanisms that can drive markets or that can exacerbate market movements? And that is an agenda that we've been having for 15 years or even longer. And of course, it's natural that the market, of course, may be one step ahead. But I think you're absolutely right, David. It's an international obligation of market supervisors, especially, but also linked, of course, to the banking supervisory business.
Well, I'm sure Christopher's got something to say on that. First of all, before going to Christopher, because I know America is always going to be ahead of the game in excess, and so I want to go to you in a moment on that. But first of all, Sevinch, we heard a bit about market infrastructure, and indeed, we were being reminded about March, when it did look as though markets on both sides of the Atlantic were really under great strain. That must be very bad news for you on the investment side if you can't get the price discovery, if you can't get the liquidity. How do you think in general the market regulators are doing in terms of just making orderly markets so that people like you can do your job properly, particularly in public markets?
Oh, that's a tough question, because as an investor, you would like to do more, but the regulator would like to control us. So you should have a middle ground, but it's very difficult, because when the market is excessive, then everybody's going to risk. When the market is okay, then everybody would like to have more yield. So there should be a balance between, but it's very difficult. It's very difficult, because also with wildcards, because regulators are setting rules, like with Enron, but then it happens again. I think it's more a cultural thing than making rules. You have to make the culture at the companies in much more better, and then you have got the persons at the regular side that should ask what the culture of that company is. I think it's not the rules, it's more the cultural thing.
I think that's very true, and I also think the pension funds can play a great role in that worldwide. Christopher, you were around at the time of the financial crisis. You can tell us about the differences and the similarities in the regulatory landscape.
Well, first of all, I need to defend my country against your accusation of American excess. Maybe it's, just because I wore an orange tie doesn't mean that I want to carry us off without any standard at all. But I think it is an important lesson to learn, and also an important topic to explore, which is comparing this crisis to the previous crisis. And I think Martin and others have said this quite well, that we are very lucky, and Luigi as well, that we're very lucky to have well-regulated banks, well-capitalized banks. Not many of them are sending thank you notes to their regulators these days, but they should. What has opened up in the United States is a lot of non-bank actors coming in to finance, particularly mid-sized companies in the US context, who can't get loans from regular banks, from money center banks anymore. And what we've seen is when the market sold off, there were big disruptions in the plumbing and market makers weren't there. And there was a very unfortunate lack of liquidity in those days. But when the Fed came through, markets, private actors came in to finance these companies. So when the Fed backstopped the markets and said, we will be here to sort of support, make sure they don't overshoot one way or the other, a lot of private capital from pension funds, from endowments, from GPIs came in to help stabilize things and to finance the continuing recovery. So I think that there's a lot to be studied there, but I think we're very fortunate that that's actually how things have played out.
Luigi, Federico, I've got a question from the audience about gold. I mentioned gold before. You're one of the top 3 official holders after the United States and after Germany. Banca d'Italia has not sold any gold in the last 10 or 15 years. I know 1 or 2 people in Italy would quite like to get their hands on your gold. The question simply asks, what should I do about my gold holdings? Should I sell at this high price or should I buy more?
First of all, okay, that's a nice question. First of all, one should say that there are, of course, historical reasons behind central banks' large holdings of gold. They rarely cover whether Barbaros or not, of the times when gold were the official anchor of the International Monetary Order. There's also an aura of like solidity around gold. The former deputy governor Salvatore Rossi, in a nice little book, says that people have psychological reasons to attribute to gold quasi-magical properties.
Well, Freud wrote about it. I mean, all kinds of people have written about it. You're right.
Yeah, and I can testify of the awe that people show when they are take a glimpse of the vast array of ingots in the Bank of Italy's vaults, which is a very rare occasion, of course, because of security rules. However, beyond any mystical aspects, there are eminently rational reasons to make gold part of a central bank's assets. And portfolio diversification is essential for central banks' long-run outlook and ultimately for independence. Therefore, a bit of diversification between paper assets, if I can use this expression in a paperless world, and a commodity, and specifically one that people often turn to in troubled times, does make sense. And I think that the last few months have provided a textbook example. The Bank of Italy's estimated financial risk increased considerably because of the pandemic, but due to both increased uncertainty, increased market volatility, and to an expanded balance sheet. Meanwhile, the price of gold went from record high to record high, thus providing in a balance sheet coverage to the increased risk. Now, whether the share of gold in the bank's balance sheet is exactly optimal for risk management, I can't tell. And
it's something like 66%. It's 66%, isn't it, for Italy? That might be a bit risky.
66% of what?
Of your foreign reserves, apparently, yeah.
Well, it's
a bit high.
According to my, well, you have to keep in mind that although we haven't sold any in physical terms, the size of the balance sheet has increased so much that now gold is just above 10% of the whole balance sheet. So it's much less than it used to be. But be that it is may, in market terms, this has not been a bad time to hold those yellow glittering bars in our vaults.
Yes, I do remember an old gentleman who was the general manager of the Bank for International Settlement some years ago, René Lahr. He said, "Down in the vaults lies gold, unused but not unloved," and that really does sum up that story. In fact, one of the findings we
well,
found
if I may, David,
yeah.
Unused but not useless.
Unused but not used. So one of the findings in our survey actually was that 13% of sovereign funds intend to increase their gold holdings, which is relatively substantial. Sevinch, there's many questions I'd like to ask you, but one of them is indeed this question about commodities. As one of the directors in charge of strategy at PGGM, how do you see the general question of investing in commodities, not necessarily gold? Because there is clearly a search for, as you said before, quotes, alternative assets, end quotes. How do you, again, balance that with the needs, your fiduciary needs of your pensioners and your other benefit holders?
Well, that's a tough question because commodities, we can say it doesn't offer yield, so we are not so constructive on that because of that reason. And the other alternatives are offering yields. That's the reason, because gold, etc., they are basically, okay, government bonds give also negative yields these days, but if you look at the long run, it doesn't offer yields. So we are not so constructive on commodities as well.
And a question again coming from the audience for you, Sevinch, and I want to put the same one to Didier in a moment. We heard earlier on from Lutke Schuchnecht that sometimes the so-called ESG investments are not actually the ones that do actually produce fewer emissions. There is sometimes a balance between what the scorecard tells us and what the actual emission data tell us. Do you have your own set of benchmarks, Sevinch, at PGGM to tell you what kind of benchmarks you should be using for your ESG investments? Because as Lutke Schuchnecht says, it's a very, very complicated area.
That's true, because everybody has its own ESG benchmark. So we prefer just a normal benchmark, and then we exclude the assets which we don't then make it customized. But we are using just the normal benchmark because we would like to measure us in the market. There are some initiatives in the market, but we looked at those benchmarks and we were not a big fan of that. It's a very technical story, but we prefer the normal benchmark because we would like to also measure us with the other pension funds, with our peers in the market, whether we are doing the right things in order that we can improve our investment process.
Well, I was going to ask you about that as well, because after all, there are a lot of pension funds in Northern Europe. There's gigantic ones in the Netherlands. Do you actually team up with your brothers and sisters from, say, the Northern European pension funds on ESG benchmarks? Because together you could move the world.
Yes, we are doing. In fact, we teamed up last year to have the measurement for sustainability development goals as asset owners, and we would like to open it also for other asset owners as well, because what I said before, we would like to create a level of playing field, because we say we invest in this ESG topic, but we would like to measure in the same way, because we have also a regulator who is checking us whether we are doing the right things. And if we team up with the other peers as well, and we are using the same numbers, then we are more transparent. We did it, actually.
Yeah, and also you have greater power. I mean, Didier, I'll come to you in a moment, but Christopher Behrings has done a lot of work on this, and you're doing more and more now on aligning these benchmarks and teaming up, not just with other asset managers, but also with asset owners. This whole question, big question, how does that strike you? How do you go about this question of harmonization?
Well, I think it's still very early days.
This is for Christopher, and then on to Didier. First, Christopher.
Yeah, just very quickly, I think we are approaching this with our eyes wide open. It's also clearly a priority for us, but it's also a moving target. I think the industry is going to be evolving very quickly over the next few years. One of the very interesting and troublesome elements with these ratings or benchmarks is, do you rate achievement or effort? And a lot of companies, may not look so good on a particular static basis, but are actually, because of engagement that we are undertaking with them or the market undertaking with them, showing signs of improvement on a variety of metrics. So that actually adds another layer of complication to the whole process. But it's clearly at the center of our attention.
There are some questions coming in from the audience actually about benchmarks, and some of this may be things that we can follow up afterwards. Sivinch says people who are interested to know exactly what your benchmarks are and how you work them out, but maybe we won't go into that now because we're going to be running out of time in a few minutes. So Didier, you at your company, Amundi, you've been pioneering this idea of low carbon investing for some time, and you're part of a series of different people that do that. But again, you've got investors who want short-term returns. How long will it take for these returns in, say, the environmental area to actually show through into the bottom line for investors? So how do you reconcile this primeval human desire for short-termism against the long-term desire to do good for the planet?
Yes, first of all, what we must say is that the performance over the past 3 years has not been has been quite good. I mean, from a relative standpoint, and there is a huge social demand for these kind of products. So my point is that it's not only about the return. The return has not been disappointing so far, and there is this increasing demand that we are seeing. And it's not only about environment. So for sure, CO2 emissions are key, but it's also about the social pillar and the governance pillar. And our take is that the social pillar will probably, looking ahead, play an increasing role because you have a new social demand, for rebalancing the thematic of inequalities is something which is very important to monitor very closely in this environment. So my point is that it's a hot topic. It's quite difficult to deal with. But at the end of the day, given that the focus is on these products, all investors, all providers will need to clarify their investment decisions. And my take is that at the end of the day, it's not only about the environment. The environment is key, but it's also about the social pillar that will probably play an increasing role looking ahead for investors.
Thank you. We've got about 5 minutes left before I go to hand over to Francis Barney from Bank of New York Mellon on the asset services side to round off. So I've just got questions for all of you now, starting off with Sivinch and ending up with Christopher. A quick question for you, Sivinch, on the safe asset, which we heard about before. When this European community bond comes along, how will that rank in your investment strategy compared with, say, the German government bond or the Dutch government bond? Will you give it any kind of differentiation? Will you say, let's have that asset because it's new? How are you going to treat that new asset when they start to issue the bonds in the first quarter next year?
Well, first of all, we have to look at it to the conditions of that asset and also to the underlying and also to the credit metrics as well, because for us it's the Dutch-German prime AAA. So it depends on the rating, it depends on the conditions. So we are not dogmatic to say no, but we are just open, but we have to see the details. It's not crystallized, so I can say yes or no, but I don't give it a proper answer. So first we have to see the details. That's it.
Right, that's a good answer. In fact, we don't know very much about it at the moment. I've got a question for you, Martin, and then Luigi, and then Didier, and then Christopher. So, Martin, when will we see the pandemic emergency purchase program being phased out? Will it really end in June next year?
I mean, there's many aspects embedded in your questions, David, if I may say so. I mean,
there always are.
Yeah. There are many dimensions. You have to be really careful, as always. I realize. Well, David, we have we had the top up just a few weeks ago. That's what we have. There's communication that we are going to do net purchases at least until the end of June. Yes, and then there's additional communication already that reinvestments from these programs, that when bonds are coming due, will be made until 2022. So that's basically the communication, plus the additional part that once we disinvest this program, we take into consideration the overall monetary policy stance that we have then. So that's what we have. And I would strongly expect that the Eurosystem will monitor developments related to this pandemic very closely. And we at the Bundesbank would argue that there should be a reasonably clear distinction between measures taken because of this specific crisis and measures taken because of the monetary policy stance.
Yes.
Although you have to be realistic that this is not,
it's a bit of a blurring. Yes,
might not be totally disjunct separate.
Good. Yeah. No, thank you very much. Luigi, we've seen a lot of solidarity in Europe in the last 3 months because of the pandemic. Are you reasonably optimistic that that can continue into next year when we might, I stress, might be coming back to more normal conditions?
Well, David, I think you put your finger on the issue that I think it has been most troubling for me in the European terms since the great financial crisis. That one of the big byproduct of the crisis was a lack of mutual trust, a lack of confidence across the union, and I think that leaders have risen up to the challenge at this time and provided, I think, all member countries with a real chance to overcome that kind of mutual distrust that is, I mean, we have to acknowledge that this is something that occurs in public opinion, occurs in newspapers, occurs in political debate. And I think this is a great opportunity, David, a golden opportunity to start building again.
Thank you. Didier, a really tricky question for you. Would you put investment in nuclear energy into a sustainable investment strategy?
Well, that's a very difficult question, but I would say that there are you don't have CO2 emissions, you know, with nuclear energy. So to some extent, it goes in this direction. But it's a hot topic, as you know, in Europe from a political standpoint. So that's a difficult point to answer. Just to answer the other question that you had just earlier, how long the ECB will continue its purchase program. Just want to add the final word is that the important words in the ECB communication is that at least until June. At least mean that the ECB policy is state dependent. So either we have a gradual recovery at the end of the pandemic, and in the best case scenario, we should be a gradual end of these extraordinary policies, or we have a second wave and the epidemic is not under control, and at the end of the day, the ECB should continue beyond the mid-2021. That's the point.
Well, thank you. I'm going to hand over to Francis in just 1 minute, but Christopher, I've got a question now for you as the last member of the panelists with your political analyst hat on. So far, Mr. Biden has done rather well just by staying in his basement, when the other gentleman seems to be shooting himself in the foot all the time, as the American saying goes, why take away his gun? But a lot could go wrong for Mr. Biden, and a lot could go right for Mr. Trump. What are those things that could go wrong for Mr. Biden, do you think, in the next 3 months that could disturb what looks at the moment to be relatively favorable electoral arithmetic for him? You're on mute again now, Christopher.
I apologize. I just wanted to say, could I answer the question on nuclear energy instead?
No.
No, I think there's a lot of, I think the assumption in the media right now is that the Biden administration is measuring for drapes and about to move in. There is clearly a scenario where the market continues to recover, where a vaccine comes online, where the Chinese noise comes down a little bit. We could get some much better news on unemployment. And as you point out, Vice President Biden hasn't really said very much over the course of his career. He has been known to say the wrong thing at the wrong time, and that could clearly turn against him. I will say it's a very big gap for the president to close right now, but it's certainly not impossible. And the powers of the incumbency, the ability to set the agenda, as we all know he does so well, are very much in his hands.
No, thank you. Those are very wise words, I'm sure. Francis, you are standing ready in the wings. Francis Barney, who is Managing Director and looking after global risk solutions on the asset services side of Bank of New York Mellon, a great ally of ours. We're very, very grateful to Bank of New York Mellon over the years for what you've done with us and what we do together. Francis, would you like to say a few words in bringing this session gently towards a close? Francis.
Thank you very much. Yeah, and very interesting to listen to the speakers describing some of their perspectives on the challenges and the opportunities that we're facing. And I do want to thank you and congratulations to OMFIF for the producing the report. I think it's an excellent publication and essential reading, not just for global public investors, but really for anyone with an interest in global markets, the global economy, the impact on society as a whole. So this latest GPI report comes, of course, at a critical and highly uncertain time. So not only are GPIs navigating the consequences of the COVID-19 pandemic now, but they also have the opportunity to play a significant role in helping to shape the post-pandemic recovery. So COVID-19 is certainly going to have a profound effect on the global investment industry for probably a long time. And by that, I don't just mean what we've seen in terms of its direct effect on asset prices and market volatility, but the pandemic has also brought to the fore and accelerated a number of significant trends. So the first, as several of the speakers have commented on, is ESG and non-financial sources of risk. So momentum for environmental and social and corporate governance principles was certainly already strong within global public investors before the pandemic. But the COVID-19 pandemic really has sharpened, I believe, investors' attention on some of these non-financial sources of risk. So the survey did also highlight this. The survey that BNY Mellon undertook with OMFIF and is included in the GPI report, one of the key findings, I think, was that it's really mainstream now. More than 3/4 of the global public investors are now implementing ESG within their investment process. So it's really moved from a nice to have or a sideline really into the mainstream and into a core objective of many institutional investors. So there are, though, a number of challenges with this. The first speaker commented on some of the credibility concerns and potentials with disclosures or asymmetric information. And so accessing and analyzing the complex data that is available with respect to ESG from multiple sources continues to be a barrier for investors to further integrate ESG strategies. So technology is likely to be a solution there, and that's also a common theme. So another of the speakers, and also highlighted in the report, is mentioned there's a tremendous demand for sustainable bonds, but there's a concern about access to enough issues. There may not be sufficient investments or of sufficient size to align with the demand in the market. So as the speaker from World Bank mentioned earlier, global public investors can be part of the solution by taking actions like issuing green bonds and participating in some of the infrastructure programs. So the technology is also likely to be a solution to help break through some of the blockages with those approaches to investing as well, to address some of the credibility and information transparency challenges. So the second big trend then is digitization and automated processes. This is not a new story, but again, the pandemic really accelerated and brought this trend to the fore. So we do believe, and we've seen certainly within our firm and with our clients, that the pandemic has been a stimulus to accelerate the drive towards digital and automation and the moving away from the last vestiges of paper processes that are still in the industry. So it was technologies such as artificial intelligence and machine learning that enabled our firm to cope with some of the huge spikes in volume and activity earlier this quarter. And that's certainly something that we've seen as part of the solution. So we expect that to be adopted more consistently. And then the advantages of receiving data automatically and immediately by things like APIs has really resonated with the industry and certainly with our clients. And then the third key theme that I want to highlight is the importance of resiliency in financial services. And resiliency means many new things now in the context of a pandemic environment, but operationally, the investment industry has coped well, I'd say, in general. But many market participants achieved business as usual fairly quickly, but some did struggle. And so the pandemic, I would say, definitely has brought to the fore the focus on new definitions of resiliency. So the last point then, as we're right at time, the current environment is certainly testing us all, and ultimately we're expecting it to reward those investors and those who provide services to the investors who are responsible and agile and resilient. So the importance of global public investors goes well beyond their individual investment strategies. As some of the world's largest investors, global public investors' approach to investment has a significant opportunity to influence the global investment industry, and beyond that to the wider economy and society. So I want to thank you again for the opportunity and encourage everybody to read the report if you haven't had the opportunity to. It's really core to our global health for the future. So thank you very much.
Thank you for those words, Frances. I'd now like to bring the curtain down. I'd like to say thank you to everybody who took part in this 2-hour session. Originally, we were going to launch this report in Singapore physically on the 10th of June. In fact, we're now launching it in 2 different places, but both virtually on the 29th of July. But we managed to bring it out nonetheless, despite the operational problems of the virus. And we wouldn't have been able to do it without everybody who's been so good in partnering with us. And several of the people on the panel and those certainly earlier on have been great supporters in this. I'd like to thank everybody. We had Anshula from the World Bank. We had Lutke and Frank Scheiding from DZ Bank earlier on, talking us through the ESG. Thank you for my panelists here, Christopher, Luigi, Martin, Didier, Serinch, and Francis to round us off at the end. Thank you also for your support. Hani Kablawi spoke earlier, your colleague from Bank of New York Mellon at the Asia launch. Thank you, Danai Kirkopalu, for talking us through these very, very taxing but also stimulating findings. Since this is Berlin, where I'm now, and since Shakespeare was a German poet, as you all know, I'd like to quote Shakespeare. I was reminded of this from something that you said about technology and digitization. I think in one of the plays, I can't remember which one it was, he said, out of this nettle danger, we pluck this flower safety. And I think that is maybe what we're getting at here. There will be some positive effects of this virus. One of them is certainly the search for resilience, as you said. Technology may play a role in that. I think the pension funds of this world, like the central banks and the sovereign funds, will be playing a role in all this. Thank you very much all for joining. Please do download this. It'll take you much, much longer than a sleepless night to get through the GPI 2020. And we're looking forward to having you all with us again for the GPI 2021. Maybe there'll be fewer words and more charts, more things to look at. And hopefully, as the Queen said, quoting Vera Lynn, we will meet again. Thank you very much indeed.
Thank you.
Goodbye.